Welcome to another episode of John McEntyre Show Live. I'm John McEntyre, and today is Thursday, September the 26th, 2024. We are still in Insurance Awareness Month. Um, and also before move forward, we were having a problem with connecting with Facebook, I think. So we're on YouTube, but I will be posting it on Facebook a little bit later. I think it was actually something that's going on with Meta, with the actual company, that owns Facebook. So um, our apologies for that, but we will see it soon. We will have it up and ready as soon as we're able to. So I think maybe as Hurricane Helene is coming up the coast, finally is making landfall in Florida, and maybe they're doing some other things, maybe more focused over there. Um, so, but no big problem. We're going to move forward on YouTube. So, thanks to YouTube, we're still able to go live. We're able to do live, and we actually have a good show here. Um, you know the routine. Do some wallet wins, and we'll cover our question. I'm going to answer a question of the day, question of the evening, and then we will be on our way. All right. So wallet win number one. I have paid off 34,000 of credit this year so far. Didn't know it was possible. I've never paid off this much, and that is a big wallet win. It's over what 3,700, almost $3,800 a month in extra debt payoff. So yes, that is a wallet win. Wallet win number two. I have paid off all credit cards with a lot of exclamation points. And so, yes, that is a wallet win. Um, always, like people know what I always say here on the show is paying off credit card is the that is making your wealth grow more than once. You're paying off credit card, but you're reducing interest, so you're giving yourself a good return on your money. So if your interest on your credit card is 16%, you pay the balance off, you've gotten a return of 16% on your money. So that is a good wallet win. 16%. That's you have to be a professional investor in the market to get 16% returns. So yeah, wallet win number three. I just achieved my first month without overdraft fees. That is a huge wallet win. That's another. You gave yourself a big return, and understand how stressful that can be. A lot of people they have that problem. Um, they end up, paying 100, 200, a couple $100 in overdraft fees for the month, and that's serious. So just getting yourself on track to where you're just no longer having to pay overdraft fees is a big win in itself. That's another big return on your money. That's a nice return. So three good wallet wins there. Having paid off $34,000 so far this year. Having paid off all credit cards and just achieved my first month without overdraft fees. Big time wallet wins. Those small steps to those big goals, and that's what wallet wins are. And we welcome you to share your wallet wins. Just put in the chat or the comment section hashtag wallet win. We see it, we will share it. If you have a question, put an uppercase Q. We see it, we will share the question and answer it. Do our best to answer it. If you have comments or you just want to share something, share a story, whatever, we will make sure we see it. We will share it there. All right. So moving on, our question for today's show came from someone, and basically what they were asking was, is it a good time to actually um, refinance their mortgage? So I was going to answer that one. It's been a couple of them, mainly because we need to um, you know the fact of the matter is that mortgage the feds reduced the interest rates, and so our mortgage that actually made mortgage rates drop, and so compared to this time last year with the refis coming in, so far it's up 118%. And so that's a lot of people doing refis. And what people were wanting to know is basically, is it a good time? Will they fall anymore or whatever? And it doesn't matter if they, well, it does matter if they fall, but there are some other things to think about before you go into, doing a refi on your mortgage. Because what there's a saying in real estate when, you know, buying a home, you marry the home, but you date the rate, because the rate, you can cancel, do whatever. You can cancel the date, but you're marrying the home. You're attached to the home, but you're just dating the rate. And that means that if you purchased the house when mortgage rates was high, you can refinance when the rates fall, and the rates are falling. So what we have to remember with a refi also is that when you refi, you're replacing your existing mortgage. So it's like getting a new mortgage. It's like going through the process. You have to apply for the loan. Which means you'll have a home appraisal. You'll pay closing costs. And the main difference is that instead of shopping for the new house, you'll just keep your current home, but you are applying for a new mortgage. Now, with those fees, and I'll mention it before also later on, um, that can be with the fees, depending how, you know, long ago you actually got your mortgage. You may be able, if they're still, current, if everything is still current, like, the appraisal, things like that, if it's still within a certain window, still maybe to be able to use that and maybe avoid some of the fees. But that's rare, but it does happen, and I'll remember to mention that also again. But so you have to remember, whenever you bought your first home, you had all of those fees, and it took about 30 to 45 days to complete. So you also have to remember that. But the main thing is, when it comes to doing a refi, you want to ask yourself, why do you want to refinance your loan? That's what you have to really, really ask yourself. And there are many factors to consider when you want to refinance a loan. And before you do that, there are some things that you should know before you try to to actually do the refi. Um, Number one, you will need equity in your home. Most of the time to do the refi, and usually at least 20% equity in the home to be able to do it, to justify and to qualify for a refinance. Most banks, that's what they want. Most lenders, um, mainly because the closing costs and all of this can run into the thousands. They want to make sure, that you'll be able to cover all of this type of stuff. All of the money is there. And because of this, you'll want to make sure you've been in the house long enough to recoup those costs, not costs, costs. Um, so, general rule of thumb, also, for it to make financial sense, is the rate's going to drop at least 1%. Me personally, I like to see 2, but a rate drop is a rate drop. Some people, they'll take whatever they can get. So, um, if you if your mortgage is 7% fixed rate, and the rates have dropped down to 6%, um, it might justify it. It could change. It could actually change the costs and things like that. It could reduce your monthly payment and all, things of that nature. So if that is the case, then you move forward. It's a personal decision when it comes to that. You just want to make sure that it's going to make financial sense. And with the why, a lot of the reasons why, some of the main reasons people want to refi is they want to switch from an adjustable rate mortgage to a fixed rate mortgage. And most of the time that's because with an adjustable rate mortgage, they usually let you in at a very low mortgage rate, um, for, let's say, five 5 years, and then after that it increases, depending on what type of an adjustable rate mortgage you got. Um, So it says right now you have a 4% mortgage rate, and in 5 years it's going to start going up 1% per year for 2 years or something like that. So it may actually, or it may have a certain percentage that it may go up to. It may go from a 5% to a 8%. Well, if it's going to do that, and the mortgage rates now are 6%, then it's time to do a refi. You can get locked in, so you won't have to go. Your payment's going to go up because it's going to adjust up because you are moving up. But that's better than going all the way up to an 8% or whatever. So you may want to do it. So you just look at your mortgage and make that decision, um, just to avoid those future rate hikes. Uh, you may want to eliminate your mortgage insurance of FHA loan, because regardless of the down payment side, FHA loans, they require mortgage insurance for the entire life of the home. And one way to get rid of it is to refi to a conventional loan once you have 20% equity in the property. So that is something to think about. Um, you may want to change the length of your loan term. Say, for instance, you could be in a 30-year mortgage. You chose a 30-year mortgage. Now your finances are much better now. Your credit is good. You can actually afford a higher payment. So this is the home that you are going to stay in, and you want to get it paid off as quickly as possible. Say, for instance, you want to go from a 30 to a 15-year mortgage. Well, that would make sense because you've decided at the beginning you had to maybe do a 30-year mortgage to afford the payments, and then you worked on increasing your income, things like that, and improving your credit score, cleaned up a lot of things. Your debt to income ratios are much better, and so you can actually afford that 15-year mortgage, and you're wanting to pay it off. Then that does make sense. So um, some people, they want to tap into their home equity. They actually want to do a refi and cash out to maybe improve or for whatever personal reasons. Um, Sometimes, if you know it doesn't make sense to do a full refi, that's when people go the home equity line of credit, or the home equity loans. They may go that route if they're going to fix up the house, to update it, things like that, increase the value of it, stuff. So sometimes people want to do refis for that purpose, to fix up the house, or for whatever reason. But if they can't go that route of refi, then they may go the home equity loan or line of credit. um, so that's the one that a lot of times people pull the cash out. They do it for other reasons, but that's usually the only reason it makes sense when you're trying to pull cash out. uh, and I said it earlier, but this is one by itself. Your credit has improved. Your overall financial situation has improved, and so you can actually get a better loan. Lower your payments. Your credit is better, and all of this. So you can actually really get a lower rate. You might even, the rates are falling. You may even be able to go below that, because just because the rates are there, that's just the average overall. That means that there are people with much lower interest rates. I mean, we've done that ourselves. We did it a couple of times. you know, the rates was falling, situations were getting better, and we were taking advantage of it. We've seen quite a few people. Is a lot of people, they play that game, um, to financial situations increasing, so you can actually qualify for a much better mortgage now. One of the big ones that happens more often than people think, they're just wanting to take someone off the loan. Say, for instance, they had a co-signer, and now they're in a much better position. So the refi, they're able to get the refi in their name only. So they're going to refi to get this other person off. Or it just could have been an agreement. The person co-signed to help them buy the house because they couldn't qualify for the house by themselves. And so now they're able to carry everything. they can do it. The bank have said yes, so yes, it's time to refi. And it may have the equity, and they may be taking some of the equity to pay back, give some interest, or maybe the person said, in so many years or whatever you refi, and this is what it takes. Or it could be a parent that just said, I'll do it, but you have this amount of time, and I want to be off the mortgage. And so that's why a lot of people will refi. So a lot of times it doesn't make sense to refi. And the reasons it won't make sense is because you just can't get the lower interest rate. So why do it? That's the main reason why you wanted to do it. You can't get the lower interest rate. So just don't go through the process paying all of the extra money, the extra fees, because that just won't make sense. Another reason may not make sense to make to actually do a refi. You're planning to move soon, so there's no reason whatsoever to do that. Um, uh, you're almost done paying off your mortgage. You've been in it a long time, because the clock starts over when you do a refi. Say for instance, you have a 30-year loan, you've been in the house 10 years, you refi, you just added you've gone another 30 years. So let's just remember, now some people do use that as a strategy, because there is a group out there, wealthy people, they're building wealth. That's their strategy, to where they don't plan on ever paying their mortgage off, because it's cheap money, what they would call cheap money. And so, you know, they have a low interest rate, 3-4%, and they're like, I'm only paying 3-4% for this money. This is cheap money. And so there's other places I could be using my other money to do, like maybe buy investment properties or something like that. So, but if you've been in the house longer, for a long period of time, think about that. Do you want to start that clock over? Now, if it's just been 1 or 2 years or something like that, then no big deal. Um, Especially if you're, like I say, if you're going to be in there long enough to recoup that money. And what I mean by recouping the money is, if you say, for instance, your closing fees were, $6,000, and you've lowered your payment, $100 a month. So you basically need 60 months. You need to stay in the house 60 months to recoup the costs, to recoup that money. So if you can do that, then you're in good shape. If you're planning to do that, then good. Anything over with 60 months, 5 years, you're planning to stay in there longer than 5 years, then good. You're going to recoup that cost. So it makes financial sense to actually do it. So that's also what to remember. That's the math of it. So, you know, what you want to do before you refinance, your loan. Um, assess your finances, as we've talked about. You want to make sure it makes good sense. Uh, Credit, income, everything, because you are going to be applying for a new mortgage. Research the rates, because they fall in 6% here. They could be 5.5 somewhere else. They could be 5.25 somewhere else. So you make sure and research. First place, you want to talk to the bank or lender who's holding your mortgage, and let them know, hey, I'm thinking of refinancing. What do you offer? And I am looking at other companies. And then, because that's what they're in the business of doing, is loaning money. So they don't want to lose loans, especially mortgages. Those are nice long investments in their book. And so they do not want to lose them. So make sure and let them know that's just leverage. That's negotiation leverage. Of just saying, hey, I'm looking to refi. What can you do for me over here? They're saying they can do this. I'm looking at a place that's already said 5.5. If you want 6, they're doing 5.5. One said they can do 5.25. What you got? That's basically what you're saying. So just think about talking to different lenders and banks and stuff. Um, and like I said earlier, just factor in those refinancing costs that you would have to pay, and so you can do your math on how long it would take you to recoup that also. So because you have loan origination fees, you have the appraisal fee, the application fee, credit report fee, title insurance, discount points, things like that. You may have to, pay up front. So you have to calculate that break even point. And also, last but not least, you just want to consider when is the best time to refinance for you. Because just because the rates have fallen, just remember it may be a good time to do a refi, but not for you. So you have to just look at your overall situation, look at the big picture, because some people, they'll do that. They'll go through that process of doing a refi, and then a year later they're being relocated for their job, or something happens and they have to move away, and they it was unforeseen or whatever. But most things in life, you can see it coming. You kind of know. If you have a parent that is starting to get sick and you notice it, you have to take into an account, will I be moving, or will they be moving here? Just things like that you have to think about. So really look at it before you make that decision, because if you do it and you don't have enough time to recoup your money, you really lost money. You did lose money. So that's something to think about. So those were just some of the points of answering the question, should refi. And so I gave all of that just to say it depends, like I always do. I just answered it I gave my definitive answer on the backside. It depends. All of that I just gave to you, that's what you need to consider before you make the decision for yourself. And so, that being said, our question of the day, question of the evening is now a good time for you to consider a mortgage, to consider refinancing your mortgage? That's the question. Is now a good time to consider refinancing your mortgage? And that being said, I hope I gave some good information. If I did, like the channel, subscribe, um, go to Facebook, like it, share your wallet wins, share your comments, your questions, send us your questions. It may be time to sit down. You may need to sit down and talk to someone about looking at this financially to see if it's a good time to refi. Give us a call. We'll set up an appointment. We'll talk to you virtually. You don't have to meet face to face. You can meet virtually or over the phone, and it's free. Maybe time for that free financial checkup to let you know if you're in a good place to actually do a refinance. So I hope that was some good information, and tune in tomorrow, same time, same channels. Good evening, and stay safe.